Is bad news again for the market? Manufacturing activity and job openings remained at lower levels in the latest data this morning. And we'll get more clarity on the Fed's thinking from that last meeting, which had those dovish rate hike projections when their minutes come out at the top of the hour. Steve Liesman is at the Federal Reserve with more. Steve, what do you make of it all?
Well, we got the soft landing scenario this morning. Kelly got a little bit of help from the economic data with a decline in job openings and the quit rate, along with the manufacturing report showing easing inflationary pressures. Take a look at the data. The ISM manufacturing, it was up 0.7 to 47.4, but it's the third straight month it's indicated a contracting economy that is below 48. ISM, the index, though, the price index, it declined, and so that's a good measure for the inflation outlook. Job openings, the Fed looking for easing in the labor market, did get a little bit, 8.79, lowest level since March 21, but still well above the pre-pandemic level of around 6 million. The quit rate at 2.2% also declined back more towards normal. Now, Richmond Fed President Tom Barkin this morning, perhaps giving a preview of what those minutes are going to say. Yes, cuts are penciled in, but no, they're not guaranteed and may not come as quickly or as extensively as markets expect. Yeah, Barkin saying a soft landing is increasingly conceivable, but not inevitable. There's a potential for rate hikes remain on the table, and cuts depend on inflation easing. About that, he said, well, weaker demand or more Fed hikes may be needed to bring down inflation, and the recent decline in yields and the rise in the stock market, it's going the wrong way. It could stimulate demand, so he's a little bit nervous. Markets, unfazed, trading with a 74% probability of a March rate cut. They priced in a quarter-point hike at most meetings after that. So the January 25 contract, that's the one we look at for the full year, shows 6 full cuts baked in with that current yield of 3.84. That compares to the average Fed official who's baked 3 rate cuts into their forecast. So like Barkin, most officials have leaned against the market's aggressive pricing, but to little avail. The minutes, maybe they'll do this. They'll do the same, and we'll see if it has any impact at all, Kelly.
We'll see. Steve, stay with us. So my next guest is in the camp that thinks the Fed won't cut as much as expected this year. Mike Englund joins us now. He's chief economist at Action Economics. Mike, I mean, it is fairly common for us to hear people saying, no, the Fed's not. I don't know. Maybe we'll continue to be surprised by this disinflationary impulse, and they will cut in March, like Goldman thinks. Why are you not in that camp?
That certainly is the hope. If you think back to last year at this time, we ended December of 2022 with a pretty distinct downtrend in inflation, and the markets really got excited about that, really didn't follow the lead from the Fed. Turns out through seasonal adjustment changes and then some ugly inflation numbers for January and February, by the time we got to March, the downtrend in inflation was still evident, but not nearly as steep as seen at the start of the year. Here we're sitting in kind of a similar situation. We are assuming that there's going to be a continued downtrend in inflation, but there's risk in January, for instance, that big minimum wage hikes in quite a few states, like 20 states, are going to be hiking minimum wages. That's going to have an upward impact on the wage data. And if we get some bad luck on the core numbers, we could easily completely quash a lot of this market perception of this string of easings. I think the Fed's probably got it right in looking for 75 basis points in cuts. Since they revised their economic outlook 4 times a year, we assume they'll skip March, which is the next time, and start their cutting sequence in June.
Yeah, I guess the question then is, how the market is likely to react to that. Not that that's what you have to think about one way or the other. But what do you make of the kind of weak trading action to start the year off? And Mike, you know what I mean? In the data, I don't know, you could look at it as maybe it was good, maybe it was not so good.
I think the market really got ahead of itself. If you look at the drop-off in mortgage rates, it started in the 3rd week of October. That's when we hit the peak. It's exactly the same as last year. In 2022, mortgage rates peaked in the 3rd week of October. This time they dropped pretty dramatically into year-end. Stock markets rallied quite a bit. I think the market just has gotten ahead of itself. The overall outlook is good. I think the prospects for inflation slowing through the year are positive. It's just that they're pricing in too aggressive a move, and I think part of the reason why we've backstepped a little at the start of the year, aside from the problems we're seeing in the Red Sea and the uptick we've seen in oil prices. Beyond that, I think maybe the market's just catching its breath.